world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today, Rebank co-host Aman Ghei of Finch Capital is joined by Silvi Wompa. Silvi is head of portfolio underwriting at Swiss Re, one of the largest reinsurers in the world, with over $30 billion in revenue. Over the past 18 years, Silvi has built an international executive career in insurance, across life and pensions, property and casualty, broking, and the Lloyd's market, at companies like Hiscox, Old Mutual, and Willis Towers Watson. She also co-founded Ch.AI in 2018, an Insurtech startup based in London, focused on mitigating price risk in raw materials. In this conversation, Aman and Silvi discuss the Insurtech landscape, why disruption in insurance has not kept pace with other areas of fintech, why enablement may trump disruption in Insurtech, and what incumbent insurance companies are doing to stay relevant. For all of our past episodes and to sign up to our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Aman Ghei and Silvi Wompa.
Silvi, welcome to Rebank.
Thank you very much.
We're going to have an interesting chat today about industry of insurance, and the word I like to use, Insurtech, these days. We've used that word quite synonymously over the past couple of years with startups that are trying to disrupt insurance companies, typically trying to build the next MGA or the next insurance carrier with maybe a slicker user interface or something along those lines. And rather interestingly, kind of what's happened is, unlike the digital banking space where we've seen a couple of these players, albeit not most of them, but a couple of them really break through, we really haven't seen that in Europe or in insurance in general. And so maybe this is a really great place to start off with, is, in your view, what do you feel is that reason for these insurtech companies in the disruption space not really living up to that hype that companies in the digital banking space had?
Sure. Well, thank you, Aman, for inviting me. Great to be here. So I think there are, as always, a couple of things influencing that. First of all, I think we need to remember that insurance overall is behind banking. So it is a more old-fashioned, traditional industry. So personally, I have no doubt that we will see the disruption. There's just a time lag because banking was just so much further ahead compared to insurance. That's the first thing. Secondly, I think that compared to many banking services, insurance is still a product that is sold. It isn't bought. So you cannot rustle up the same amount of consumer enthusiasm around insurance as you possibly can around banking. So I just think that the pull has been weaker compared to many banking products. Thirdly, we also have to know that the insurance industry was built for the big players, and especially the regulatory requirements on the capital side make sure that this has been so. Of course, that does not preclude anyone from going into trying to make distribution or claims management slicker, but if you really want to talk about the core of insurance, which is underwriting, as a small player, the odds are stacked against you. Now, I think those are some of the fundamentals. Then if you kind of look at the waves of Insurtech, I think you can call them waves. So maybe 10 years ago, the first players who came up, so your Lemonade, for instance, they definitely took the position of a challenger, a disruptor, but I think fairly soon realized that it was pretty tough to
They were trying
disrupt.
to build full stack insurance.
Yes. And I think they found out pretty soon that that was easier said than done. And I think there was a kind of sense among the incumbents that, look, you can't really disrupt us in that sense. I think the second wave, which then started maybe about 5 years ago, talked a lot more about enabling rather than disruption. So I think there was perhaps a sense of self-censorship in terms of using the word disruption, because the realization had been that this is going to be tough, so we might just adopt a different vocabulary. So I think the word disruption has disappeared a little bit among those who are actually in this field to begin with. I think today the way that comes up a lot and talked about a lot is ecosystems, which again is a very friendly word because we all think of ecosystems as sort of animals living happily together. Again, I think it's a bit of a euphemism for what is actually going on.
Got it. I want to pick up on the third point that you mentioned initially, which was around the capital requirements for a so-called insurance disruptor. In the banking industry, I think it's fairly transparent that if I want a banking license, it's going to cost me whatever it is, 10 million. And I need to find investors. And these days, I think venture capital investors have deep enough pockets to fund banking licenses if you're trying to build an interesting enough proposition. What is it like on the insurance side? Why haven't venture capital investors who have deep enough pockets, or for that matter of fact, any investor where there's enough capital in the market, funded insurance capital requirements?
I think part of it comes down to most people knowing very little about insurance and how insurance truly works. Since my McKinsey days, I have a lot of fellow alumni in the private equity sector, and I've been nagging them for years about investing into insurance because I think there's a lot to be done. And they've always kind of shaken their heads and are like, nah, that's not for us. And I think what the insurance industry as a whole has been great at doing is to literally adopt a vocabulary that makes it very hard for anybody outside of insurance to understand what it's actually about. Now, in my view, insurance is pretty much like any other alternative asset class. It's illiquid, it's long-term, it has its sort of funny aspects, but fundamentally it's an alternative asset class. But most people in insurance do not necessarily view it that way. And I think that barrier has allowed people to kind of put up a view that insurance is special, it's difficult, it's really complex. And of course it is, it's not easy, but it's not rocket science either. And I think technology and what technology can do is starting to break down some of those barriers, showing that no, you do not have to be running around with papers in a leather binder to do business. I think the veil is starting to fall, and I can only see more along that path coming.
Interesting. And to your second point, a lot of the startups in the disruption or the first wave maybe pitched the idea of falling in love with your insurance company, for instance. Do you think that's possible ever? Just the dynamics of insurance are such that the insurance company makes money when the claims are, I don't want to say not paid out, but when their loss ratios are low. The customer is happy when their claims are paid out. So there's this kind of conflict of interest, so to speak. And as a result, the dynamics between a customer and their client is very different to any other industry. So do you think people can ever love insurance? And does that have an impact on what future companies do in this space?
Now, I don't know how many people love their banks either, but I think there is definitely a case for increasing the degree of like. And I think insurance as an industry has not done enough to promote all the good stuff that insurance does in terms of helping the world be a more resilient place, because insurance actually does play that role. Maybe not for you and me in central London where we are today, but definitely for farmers in India or people in the Caribbean, for instance, who have their homes ravaged by tropical storms. I think that you can definitely increase the degree of love, by talking more about what insurance truly does, but also by increasing the degree of relevance. And I think because we're starting from a pretty low level, I think it wouldn't take much for people to say, hey, this actually makes sense in terms of putting out terms and conditions that people can actually understand to begin with, that actually meet their needs and not a lot of things they don't need, or then not covering what they actually do need. And also combined with a much more user-friendly interface, because again, we start from a very low level, so I don't think you have to do that much to just increase the like rating a little bit.
Yeah, I think a lot of the focus initially was on just creating better policy wording so people understand what they're actually buying. Because I think at the end of the day, people who buy insurance want to make sure that in the event that a catastrophe or the reason why they buy insurance occurs, the insurance company has their back. And at the end of the day, that will only be possible if the policy wording is clear, the products are not complex, which you could argue that there are certain verticals in insurance that products are extremely complex even today.
You know, there just hasn't been enough incentive to change that complexity, and the level of comfort in the industry has been so high either that there hasn't been a force driving any sort of change. But of course, I mean, if you just look at the whole gig economy, for instance, who wants to buy a policy that covers you 24/7 for a whole year if you're a gig economy worker and you might be working 2 to 3 hours a day using your car or your bike? That's a hole in the head. Of course, if you can find an insurance which are available today where you can get cover exactly for the hours that you work and you pay for that, fantastic, because then it actually fills a relevant purpose to you, which insurance should be all about, but today to a large extent isn't.
Got it. Let's dive a little bit deeper into that, because I think it's interesting, especially the gig economy side of things, right? When startups are working with some of the bigger companies here, particularly for capacity, right? So I think there are a couple of businesses here in the UK like Zego and tons of businesses in the US. What I find interesting is from a capacity provider standpoint, when you look at, let's call it the pay-as-you-go type model, in theory, if you're an insurance company, aren't you actually reducing the size of the market because your premiums or the ability to write more premiums are smaller because people are now only paying for 2 hours out of the 24 hours in the day versus what they would for a 24-hour policy? How do you align those things is what I'm trying to ask, if that's clear. How do you make sure that the insurance company doesn't say, hey, you know what, I don't think offering you pay-as-you-go insurance really makes sense for me because my premiums are just going to fall by 50%?
Yeah, so I don't think it's a zero-sum game necessarily, because I think some of the gig economy jobs, they haven't existed for that long. And prior to having a gig economy job, people would do something else that most probably didn't require insurance. Now, today, they have a gig economy job that requires insurance for 3 hours out of 24. Now, that's actually an added premium for the insurance company. Then again, of course, you have to ask yourself, what is the acquisition cost of those 3 hours of premium, or the cost of underwriting that in a good way? But I still believe that it is an added value. Plus the fact that as the work landscape changes, if the only way of capturing a big part of the economy and of workers is by giving them the fundamental policy that they need in order to then capture their house and their kids and their pets and whatever, then you have to do it because that's your entry point to a whole new customer segment.
Makes sense. I want to transition about talking about how insurance companies work with startups these days. The popular model has been, I'm an MGA here in the UK, and I work with a Swiss Re or a Zurich Re or a Munich Re to get some capacity from them. I do the distribution as a startup. They provide capacity, and maybe when I have good underwriting criteria or good track record in the space, we can share a profit pool and so on and so forth. How do you see that evolving in the next kind of 1 or 2 years? Or do you see that changing at all? Do you feel like insurance companies are still excited about that avenue of deploying capital?
I think excited is probably a strong word. I think it is for many a necessity to get access to new risk pools that companies would otherwise not get a hold of. So I think there will be changes happening. Given what I've seen so far, probably not super fast because this industry does move slow. But if we stay with the underwriting side of things, because obviously you don't need capacity if you want to improve distribution or if you want to improve claims, but for underwriting, sure. So I think one thing that is very interesting is what the Bank of England or the FCA is doing at the moment, where they are trialing a new insurer sandbox, which basically is an effort to see if it could be made simpler for smaller firms to become actual insurance companies.
Full stack.
Yes. Because I think with the Brexit case and so on, there's a push to maintain London as a financial centre. They have to make it simpler for people to do business, and I think they're also acutely aware of the extremely slow pace that a lot of incumbent insurance companies are indeed providing capacity. So that sandbox, I think, is a very interesting exercise. God knows what's going to come out of it, but at least it's an interesting exercise. At the same time, what I find very interesting is the interest that alternative capital investors are taking in the insurance space. Now, we've all heard of insurance-linked securities that are mostly related to nat cat risk or mortality risk. But what we see increasingly is investors capitalizing what is known as protected cell companies or PCCs, which actually enable MGAs to operate as full-blown insurance companies without requiring capacity from an incumbent insurance company. Again, that is still very much a nascent trend, and there are regulatory concerns left, right, and center, but as a concept, it is quite powerful to sidestep the incumbent insurer who is less than willing to provide capacity within a 6 to 12-month time frame.
Because the MGA revolution, I guess for our audience who doesn't know, MGA stands for Managing General Agent, happened quite quickly in the UK, right? It enabled startups for, not exactly sure how much, but maybe £500,000 million to get a license to basically distribute insurance. And so what you're saying is very interesting, because if you're able to fundamentally change the capital requirements structure, I think you will have a lot of different companies coming into this space trying to build full stack insurers if there is a right model for this. So that's definitely really interesting. You mentioned areas where you don't need underwriting or don't need capacity. So claims, fraud is an interesting one where there have been, I would say, a lot of companies raised a decent amount of money because it is a well-known problem in the insurance space. What are some of the enabling technologies you're seeing today that insurance companies are talking about or want to work with?
I'm not sure that it's that specific as yet, because I think we still have to remember, especially here in London, that we do come from a very old-fashioned industry. So I think we're still moving in quite basic terms. But to start with, just digging out the data that already sits within a company in unstructured form is the first big hurdle. Because that, in many ways, is the first challenge you run into at all. Secondly, that then becomes, so how do you draw insight from usually huge data lakes? And of course, today you hear words like machine learning and artificial intelligence, but I'm not sure that you actually need that straight away. I think you can extract insight with a lot easier tools than that, because again, you're starting from a fairly low level of insight or data manipulation for that matter. So I don't think, the level of refinement is that high as yet, but I think truly the quest now is to get hold of the data that sits there, try to complement it with external data, and actually be able to do something about the insight. Because sometimes I think what we've seen is with some of the companies out there who are trying to provide incumbent insurers with new versions of their data, is that there's actually no infrastructure to capture the so what of that data. You know that it's a valuable asset, but if it doesn't really make any difference to how you calculate your premium, it's not really that valuable. So it's just as much about sort of changing the infrastructure and how can you take the so what with you to actually change your risk insight and risk price calculation.
I guess to add more complexity to that, you have different data sources that are now arising in the market, right? So with IoT and just the general amount of devices that are available, for instance, in your home, you can do things like measure flood warning levels or whether your security systems have issues. But even things like computer vision and mapping enable insurance companies to, without having to send a surveyor down to site, price, provide at least quotation levels. And that definitely adds a level of complexity here. So what do underwriters think about that? How do they view the future of underwriting, so to speak? Because we haven't really seen a lot of startups in the underwriting space, primarily because it's a very tough space to break into and convince insurance companies to rip out their existing underwriters and actuaries and have them use this different model.
Yeah, I mean, first of all, I think, coming back to what we said about capital, I think that is the reason why we have seen relatively fewer companies in the underwriting arena. I think secondly, what still needs to be done is for the newcomers to somehow prove that the technology that they're using is actually improving the loss ratios. Because at the end of the day, that is all any underwriter cares about. What does it do to my loss ratio? Because I think we all kind of know, or at least we've had a hunch, that there's been a lot of guessing going on in the London market, at least for many hundreds of years. And by and large, that guessing has paid off reasonably well. Not recently, but reasonably well. So any innovation coming to market that requires an investment, you need to prove that it changes your what is known as loss pick. So that's another word for loss ratio. And until that happens, many underwriters are probably going to say, yeah, looks great, really nice, but I'm just going to stick to my old established ways because it's cheap, it has served me well so far, and I'm reasonably comfortable where I am, so I don't really see why I need to change. And I think that is probably a bit of a divide that sometimes exists between many of the startups, where most people do not necessarily have a background in insurance, and then the client on the other side, because I don't think that anyone hypothetically doubts the value of a particular technology or innovation. But sometimes it does come down to that number crunching. What does this actually mean in terms of value added? Only that will enable a true investment. And I think we still have some way of bridging that gap.
But can a startup do that pretty easily? I'm assuming this requires a fairly long sales cycle with an insurance company to get into the underwriting department and provide them, or do you do that retrospectively and say, here's a data set, tell us what you think the loss ratios are, and compare notes there?
So I would say it depends a little bit on what product area you're moving in, but you certainly brought up the topic of parametric solutions, where actually your ability to backtest your technology as a startup has never been better, because at least when it comes to weather data or certain financial data, it's all there and it's there for decades back. So you can quite easily backtest your algorithm or your pricing rule and show, had you applied my algorithm or my rule, this would have been the outcome. So I think the timing has never been better, both from a point of view of access to data, but also computational power, which didn't used to exist.
Got it. What do insurance companies worry about these days? What keeps them up at night?
Well, I think many things. It all depends on what kind of insurer you are. I think the Nat Cat events certainly have kept people awake, but if we're looking at more man-made situations, I come back a lot to the word relevance. So how do you stay relevant to your clients? And I would say that goes both for corporate insurers and reinsurers. So in a time where property risk, which is the traditional domain of insurance, becomes less and less important because the world becomes more virtual. We work more in supply chains. We do much more online. Risks online are different to property-related risks. There is not very much cover out there that can truly help corporate clients today. Same thing on the private client side. Yes, there is home insurance, but your home has changed and your work patterns have changed and your family circles have changed, but the insurance products haven't really followed suit. So the word relevance, I think, is a key worry, because that strikes at the core of everything else that you do. If your products aren't relevant, it doesn't matter how good your distribution or your claims management or your underwriting is, because people may not buy them or they may not buy them enough. And this is, I think, where a word I previously mentioned, the sort of the ecosystem comes into play, and where I think a lot of insurers will be seeking partnerships with startups going forward, because these ecosystems have a different type of relevance to their end clients that the insurers can piggyback off of.
And by relevance, do you mean just having a fresh UX or a new product that is suited for a particular category? For instance, connected devices in the home. So let's take home insurance, for instance. It's been a fairly focused product on contents, and we've seen, I guess, over the last couple of years, some interesting developments in deposit replacement, for instance, which is also another insurance product. Is that how they're thinking about it? Is what are the different components of products that we need to release into this market? Or is it just a fresher UX that the next generation of users understand our product offering?
I think it's very much both. Products, no doubt, but I would say even more so, how do we actually connect with our clients in a way where they are willing to talk to us? Because I think nobody kind of gets happily out of bed in the morning to go and buy insurance. At least that has not happened in my life so far, and I doubt that it will. So I think it is about that relevance. It's like, how do we even get to the client in a moment where the need for risk transfer somehow emerges, whether that is the birth of a child or the purchase of a home or a car or the take on of a gig economy job. And that is where the insurers really are not today. It's always oh Lord, I bought a car, I might need insurance. The insurance is rarely there when you buy the car, when it is truly relevant. So I think it's very much about that connectivity, obviously combined with products that actually make sense, but even more so about the connectivity.
It's almost as if insurance should be an API-first type product. On technology, so there's one company that is synonymous with insurance, which is Guidewire. And I guess insurance companies have paid millions to Guidewire and consulting companies that implement that. We haven't seen a lot of change in the infrastructure side of insurance. So maybe Salesforce is making some headway here. But do you see that as something the insurance companies worry about, or is it just not on their priority list for now?
Now, I don't claim to have the truth here, but I would say that it's not as much on their list of priorities right now, because that would basically be like boiling the ocean. Of course, it is important because that's where you can truly achieve economies of scale and true efficiency and all of that. But it would be such a huge change that I think where there's more worry is around, how can, again, coming back to the word relevance, how can we remain relevant? How can we connect with clients? And the back end simply has to work. And I think there's more focus on the more front end side of things, so products and connectivity to clients.
Interesting. And what about risk appetite? What are the verticals, whether it's in P&C insurance or anything else, that insurance companies want to explore or haven't explored yet? Where do you feel there is appetite, but maybe there's no distribution, for instance?
Insurance companies are risk averse by nature. So I think that is a painful point sometimes to talk about, because the emergence of new risks is something dangerous to begin with, right? Having said that, I think there are a number of areas that are interesting to people out there. I think the whole parametric field is an interesting one because it does a few things at the same time. Firstly, it allows for a lot more proactivity than previously, because you can pretty much know exactly what claim you have had the moment it happens, or even just before that, which means that you don't have to sit around and wait. You don't have to send out somebody to look at the claim. It just has so many aspects of a happier client journey, which there aren't that many of in the insurance world traditionally. So I think, and it brings in a technology that allows you to do things differently. It also brings in the aspect of satellite imagery and seeing what's going on, which can, again, in its own right, fuel a lot of other areas of risk underwriting and so on. So that pertains to agriculture, it pertains to the marine business, it pertains to property. It's pretty much all encompassing. So I definitely see that as an area where there's a lot of investment interest. Cyber nowadays sounds like a sort of an oldie, but I still believe that there's a lot to be understood about cyber that is still a bit of a black box. I think a lot of insurers out there do not necessarily know what is on their balance sheets. Talking of ransomware, which, has emerged as a big issue, which wasn't a big issue a couple of years ago. And I think we also see that from how a lot of the insurance products are constructed, in the sense that they're not really a risk transfer product. They're more of damage mitigation products. So I still believe that there's a lot to be done in the area of cyber, and I see that there is still interest, even if it is cautious.
Got it. And finally, Silvi, coming back to you, and you obviously run underwriting at Swiss Re. What are the things that you focus on? What is important to you? What should we look out for?
Yeah, that's a very good question. So what I do at Swiss Re is that across the 50 or so risk pools that we have, and a risk pool is literally, you can say, a more refined product line. I try to take literally the aspect that an asset manager would take, basically looking at where do I get the most bang for my buck. So as an investor, if I put my money here, would I get the same amount that I would get somewhere else? And then try as best as we can to allocate our risk capital in between those risk pools. So that is, as you can imagine, a fairly complex task, which takes a lot of time. But for me, it really feeds into this line of thinking that at the end of the day, insurance is just another asset class, slightly different, but has a lot of similarities at the same time. So what can you look out for? For me, it's also really this movement, because Swiss Re certainly isn't alone in trying to take this view on risk underwriting. There are many companies out there that have tried to do this. So if somebody could show me a platform that can do this, I would be very much interested. But it is also a question of how can we, through smarter underwriting, increase profitability in some risk pools, because it is clear that unlike asset managers who for higher volatility would demand higher returns, the insurance industry has actually often settled for lower returns for higher volatility, which is quite interesting. And I think this goes back to some of our traditional underwriting ways, not in reinsurance, but all over the place. And I think this is truly where technology can add to basically eradicate that, where we would typically see higher returns for higher volatility through smarter underwriting of the future.
Fascinating. Well, Silvi, this was a great conversation. Thank you very much for coming.
Pleasure.
Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.